Friday looked ugly. Tech dropped, QQ sold off. Names like Nvidia and Tesla fell sharply. But here's the important question. Was this the start of something bigger, or just the market catching its breath? Let's slow this down and think clearly. This was not random. Three key forces hit the market at the same time. First, rising yields, the silent driver. The 10-year Treasury moved higher again, around 4.3% plus. That matters because higher yields lead to higher discount rates, which lead to lower valuations, especially for tech. This is the single biggest reason growth stocks pulled back. Second, oil spike leading to inflation fear. Oil prices moved higher due to geopolitical tensions. That creates a chain reaction. Higher energy leads to higher inflation, fewer rate cuts, and pressure on stocks. Markets don't like inflation surprises. Third, AI spending concerns, very important. This is more subtle, but critical. Big tech is expected to spend hundreds of billions on AI infrastructure. The question is no longer, is AI real? The question now is, when does this spending turn into real cash flow? That's a shift. And markets always react when the question changes. Let's be specific. QQQ dropped because it is heavily concentrated, rate-sensitive, and dependent on growth expectations. When yields rise, QQQ feels it immediately. Nvidia fell because its valuation is still high, and expectations are extremely high. AI capital expenditure is now under scrutiny. Nothing is broken, but the market is asking tougher questions. Tesla, TSLA, is more fragile here. Why? High valuation, delivery concerns, margin pressure, and rate-sensitive demand. This is a stock that moves fast in both directions. Microsoft MSFT is more stable. Why? Recurring enterprise revenue, strong cash flow, and diversified business. Still affected, but less fragile. Google is an interesting case. It has a lower valuation than peers, and strong ad and cloud business. Plus increasing AI investment. This sits between growth and value. Apple, AAPL, is more defensive relative to tech. But it's still not cheap and exposed to global demand and tariffs. Less volatile than NVDA or TSLA, but not immune. This is not a panic. This is a repricing. The market is shifting from AI excitement to AI economics, and that's a healthy transition. Because markets don't crash from thinking, they crash from excess. Here's the realistic scenario. Scenario 1. Stabilization, which is most likely. If yields pause and oil stabilizes, the market finds support, tech consolidates, and selective buying returns. Scenario 2. Continued pressure. If yields continue rising, more multiple compression, tech remains under pressure. High beta names drop more. Key signals to watch next week. 10-year Treasury yield, oil prices, and Fed expectations. Also, big tech analyst revisions. Not headlines, signals. We do not predict, we position. What to consider buying carefully. Microsoft for durability and cash flow. Google for reasonable valuation and II upside. Apple for stability on weakness. What to be careful with. Nvidia, a great business, but with high expectations. Tesla, high volatility and uncertain near term. Strategy. First, buy in tranches, not all at once. Second, reduce concentration risk. Third, keep cash for flexibility. Fourth, focus on cash flow, not hype. Charlie Munger would not panic here. He would say, the market is there to serve you, not instruct you. When prices move quickly, people feel they must act. But most of the time, the best action is rational patience. This is not a collapse. This is a test. A test of discipline, patience, and understanding. And as Charlie would remind us, you don't have to be brilliant. You just have to avoid being foolish. If you can stay calm when others react, you're already ahead. Educational only, not financial advice.